Welcome to today's market report.
European stock markets traded lower on Friday, continuing the global sell-off after a sharp rise in bond yields weighed on sentiment. DAX traded 0.3% lower, CAC 40 fell 0.6%, FTSE 100 dropped 0.3%. Losses in Europe have been led by resource and technology stocks amid concerns that lofty valuations will be placed under extreme pressure if funding conditions tighten significantly. Minor BHP Group stock dropped 1.1% and oil major BP dropped 1.8%, while tech stocks ASML Holdings, Logitech and Adyen all fell more than 1%. ICAG stock rose 2.6% after the owner of British Airways pointed to UK plans for travel markets to possibly reopen from mid-May as a positive sign, even as it posted a loss of 4.37 billion euros for 2020. Deutsche Telekom stock rose 0.1%, outperforming the wider market after the German communications giant reported a sharp rise in net profit and soaring revenue in its fourth quarter. BASF, one of the world's largest chemical companies, also reported better than expected figures and sounded an optimistic note about the outlook this year for its biggest customer, the auto industry. Its stock still fell 0.9%. The global weakness started on Wall Street overnight as the tech-heavy Nasdaq suffered its worst day in nearly 4 months, dropping 3.5%. This sell-off continued in Asia, with Japan's Nikkei ending almost 4% lower and Hong Kong's Hang Seng dropping over 3%. Overnight, the yield on benchmark 10-year US Treasury note briefly crossed the 1.6% level to trade at its highest level in more than a year. Higher long-term rates raise the opportunity cost of holding assets that are only expected to generate free cash flow in the future. German January import prices surprised on the upside early on Friday, but both French consumer prices and the fourth quarter GDP came in below expectations. The European Central Bank has said it expects to look through any short-term increase in CPI, given the underlying problems still facing the Eurozone economy. Oil prices fell sharply on Friday as rising US Treasury yields supported the greenback, making US dollar-priced oil more expensive. Crude futures traded 1.1% lower at $62.86 per barrel. Brent fell 1.1% to $65.38 per barrel. Gold futures fell 0.6% to $1,764.80 per ounce. On the FX front, the GBP-USD pair witnessed some heavy selling for the second consecutive session on Friday and dropped to over 1 week lows during the early European session. The sharp corrective slide from almost 3-year tops stalled near the 139 conference support amid oversold RSI on intraday charts. The mentioned level compromises the 50% Fibonacci level of the post-BOE strong positive move and a 100-period SMA on the 4-hourly chart. This should now act as a key pivotal point for intraday traders. Meanwhile, oscillators on the daily chart have eased from the overbought zone and are still holding in the bullish territory. This, along with the emergence of some dip buying, warrants some caution for bearish traders. That said, the GBP-USD pair's inability to capitalize on the move beyond mid-139 supports prospects for additional losses. The mixed technical setup makes it prudent to wait for a substantial break through the 139 mark before traders start positioning for any further depreciating move. A convincing break below would turn the GBP-USD pair vulnerable to accelerate the fall towards mid-138s en route the 61.8% Fibonacci level support near the 138.20 to 138.15 region. On the flip side, the 139.50 level now seems to act as immediate resistance. Eurodollar reverses 2 consecutive daily builds, including fresh multi-week highs around 122.40 recorded on Thursday, and returns to the 121.50 region on Friday. The sharp and sudden pickup in yields of the US 10-year benchmark prompted investors to favor the greenback. The dollar index was up 0.4% at 90.468.
This is today's market news. Thanks for listening. We'll see you next time.